All right, why don't we get started? Thank you, everybody, for hanging in there for one last session. We'll do our best to make it worth your while. I think we have a great session here, and I'm honored to have these participants here to join me. I'm Roy Hormuth. I'm the Senior Policy Advisor in the Strategic Planning and Policy Group at Ginnie Mae. I've been at Ginnie Mae for 7 years, and previously I served as the single-family director. The reason we chose this topic is a lot of the earlier sessions gave you kind of the big picture of the Ginnie Mae market and a lot of the dynamics related to that. Here we're going to get into a little bit of the micro picture in mortgage servicing rights. And mortgage servicing rights are very critical to the Ginnie Mae market because, as we've discussed in several earlier panels, Michael Drain's panel in particular, the non-banks have dominated the Ginnie Mae market. So within the non-banks, their largest asset is mortgage-backed securities. So non-banks are distinctly different than banks in that they cannot get cheap deposits for their funding. So they have to go to other sources. So MSRs, or mortgage servicing rights, can act as collateral for financing facilities for them. And also, if need be, they can sell the MSRs to raise funds. So because of the non-banks, the MSRs are an integral part of the non-banks financing and net worth picture. We are very involved in monitoring that and working with that to be sure that we have our finger to the pulse in terms of values on MSRs as well as trends in the MSR market. And these guys will give us a lot of color in that because we have a kind of all-star group here of some of the most significant, prominent MSR brokers and buyers in the market. So I'd love them to introduce themselves to you.
Stephen Fleming, I'll start. Good afternoon. The reason I took that selfie was because this is the first trip I've taken with my 3 kids, and they don't believe I work on these. So I have some degree of corroboration now. EVP of trading at Phoenix Capital. We trade approximately 80 to 90 billion of MSRs per year. We do valuations for about 250 clients for their MSR book and get into some specific economics regarding their own yields, their own targets, I think some of which we'll speak to today. And before I called Phoenix Capital home, was just up the road when Fannie Mae was up the road on Wisconsin Avenue for quite some time.
Hi, I'm Brandon Story. I'm with Mr. Cooper, and I am SVP of Capital Markets. I've been in this business for a little over 21 years, representing the originator side, both on the bank and the non-bank. At Mr. Cooper Group, we are a buyer of MSRs. We're an originator, obviously. We're a top 10 Ginnie Mae issuer as well. And so hopefully we can bring some of that perspective to this panel.
Good afternoon. I'm Jim Schneider. I am one of the partners at Roosevelt Management Company. Roosevelt is an investor in both residential whole loans and residential MSRs. We are in turn capitalized by a $350 billion pension plan. And Roosevelt, so the asset we're focused on the MSR side fits that pension plan very well in terms of duration and based on their cost of capital. Roosevelt is an investor that's been in the market for the last 11 years, kind of starting out on the whole loan side, primarily initially on the legacy and season side, and have evolved to a fully diversified series of mortgage platforms. Really now focused more so on the performing business as we are on the non-performing business. We own a servicing platform called Rushmore. Rushmore has about 60 billion or so of MSR, or 60 billion of UPB on the platform, and it's our goal to try to approximately double that size in MSR acquisitions over the next year.
So great, thanks guys. So I tried to get a diverse panel here. We have people who are investors, who actually service the loans, and are active in the trading market as well. So why don't I get started with Steve? We've had a lot of movement in the 10-year Treasury. Why don't you give us kind of the big picture trend in MSR pricing and liquidity in the Ginnie Mae space?
Sure, happy to. I had two very painful things occur in the month of May. One is I had bone surgery, and the second is I bid a collection of MSR bulk packages. And not sure which actually went off better, but we in negative duration land here in MSRs, there's that corollary between interest rates and paths and interest rates and demand that we need to always delineate between, hey, this is what the model says, and I think the gentleman to my left will speak to that a little bit more, and then this is the underlying supply demand. And from a yielding asset perspective, from an unlevered pre-tax viewpoint, MSRs in the Ginnie Mae front as well as conventionals still provide a measurable amount of return. And I think it was one of the panels before us that preceded I mentioned as far as 2018 goes, it was like the fixed income asset of the year, which makes sense given where the paths of the rates were. In 2019, we are singing a little bit more of a story of I'd say of a pause of some of the enrichment that we saw in 2018. There were points of 2018 where the appetite seemed insatiable from some of the larger participants, and the interest on some of the packages that we bid and that we saw in the market, and the gentleman on my left, we're very aggressive and strong counterparties in, where the participation was, I'd say, the highest post-credit crisis. So we're talking on the conventional side, probably 10 plus, baker's dozen type bids. On the government side, probably 6, 7, or 8 legitimate executable bids received. So from an interest perspective, the demand was prominent, and we've faded since then somewhat. Although I'd say the more material fade that we're seeing, to your question, Roy, has been induced, of course, by interest rates. We saw that. You mentioned the 10-year. Let's talk about the Ginnie SF, the underlying par coupon. I think that dropped 38 or so, almost 40 basis points in May. I think we're down 10, 11. Actually, you're right. Speaking of today, maybe it's 15, but 10, 11 or so on the Ginnie SF since the 1st of June. And so on the books that we see being marked, we've sort of set up a triage line in terms of these month-end marks, and it seems like it's always towards the tail end of the month. I guess we need to adjust maybe the cadence of when we do our analyses, or the cadence upon those bid dates that we have out there. So the amount of drop that we saw roughly was on average, and this is a generic composite average, was probably in the 8 basis point range from month-end April to month-end May. And of course that varies, but that's a material adjustment, and depending upon the profile, that's going to show up on the bottom line. And we know that MSRs are level 3 asset, and there's some variance in there as well in terms of flexibility. But nonetheless, that's your median point dropping by a fair amount on from April 30 to May 31. If we did a mid-month mark, I'd expect probably half of that already cut. Maybe not half, maybe like 30% of that as another reduction of that fall. So maybe another 3 bips or so since the start of the month. So that has to manifest itself in some way vis-a-vis those models that I talked about. So the supply demand, I would say, still remains strong, and it's still a yielding asset, a positive yielding asset with Ginnie yields probably in the 10, 11, 12, fully baked, fully loaded. That's with recapture range, but pretty sharp. Not as sharp as conventional, but pretty sharp. But there's there's a model to which we're all answerable, and I think that. That has certainly picked up and is reflecting the interest rate path that which we live.
Great, thanks, Steve. Recently, we've had to deal at Ginnie Mae with fast prepay speeds of VA loans, and we've put out some APMs and worked to try and slow that down. Have you seen that to be effective, Steve? Or what effect do the fast prepay speeds have in the market, and have our efforts been successful in slowing things down?
Those efforts have certainly not been futile. We have seen a correction in behavior. We have seen a difference in behavior. It's what's been hard is trying to really extract out and triangulate the test versus control, because you're never given a pure vacuum in which to measure it. Mm-hmm. And of course, rates have been sliding quite a bit since then.
That kind of
that
obscures things a little.
It has muddied the waters a bit. And that being said, what we have seen and this is, I think, evident in some of the Black Knight reports out there as well, where month over month, year over year, March actually looked pretty good. April registered higher. And that 7 to 12 month vintage, still does show, some of the.
I mean, how does that affect you when you're trying to market a portfolio?
Yeah, so the next step of that is going to be the first question we get asked in terms of a Ginnie Mae bid. And this assumes a lot of the volume and whatnot is disclosed, but hey, let's talk about the FHA VA share. On the VA side, there is still hesitation. There's some reticence in terms of both the speeds induced by, depending upon the seasoning of where the loan's wallet is, that given VA production, and also, frankly, still the VA no bid. We talk about housing price appreciation. Generally, that's been muted. It only takes a few of those, though, to feel the loss of that come through. We're modeling. I think somewhere the gentleman on my left can confirm this as well. But what we see modeled out there in the industry for losses on the VA side and FHA side is somewhere between 5 to 6,500 on the FHA side. On the VA side, because of that no bid, Roy, probably closer to 10,000.
You want to explain no bid real quick?
Yeah, no bid, I'll do my best to, but is effectively in moments of where there is an element of loss potential on a foreclosed VA property, typically induced by home price depreciation. The VA would insure the 25% that they have to, but then you are in a position to withstand the rest of the loss. And that could be in the thousands of dollars, and we model that roughly at 10,000.
So that's why that's a significant factor, yeah.
It doesn't take many of those
No.
to upset the apple cart. I think we're going to talk about servicing strips later and talk about the viability of those. But for home price appreciation, so we're based in Denver, and in March, for the first time in 78 months, and I see some in the audience who could fact check me on this from Denver, but for the first time in March, in 78 months, Denver had housing price declines, which makes a specter like this, I think, all the more possible. Now, in full disclosure, since then in May, Denver just set a record for home price sales amount, so it came back up, but nonetheless, it feels like that sawtooth could be back.
Okay, thanks, Steve. Then, what do you see as the pros and cons of Ginnie Mae MSRs versus GSE MSRs?
And I think the last point here is going to get to, on the pro side, it's a story of yield, and it's a story of if you have faith in the model and faith in the path forward. The Ginnie Mae process has become quite improved over the years, and it's the ability to attract an investment in which you have faith that is yielding a more competitive return than on the conventional side. The breakdown of the composition of a Ginnie Mae portfolio is one that requires some surgery, in terms of is it FHA, then where are the geographies, if it's VA, where are the geos, as far as trying to triangulate the bases, if it's USDA, how does that impact the entire composition. And on the con side, it's not necessarily a con as much as it is the need to be crystal clear about the assets that you are assuming for acquisition. So, for example, I think we talked about before some of the more meticulousness around the 19 servicing fee strip, versus a 56 spot 5 or anywhere in the middle. And we've run some recent numbers about the 19s, for example, and what does it take to, sort of consistent with the APM that came out, to render those viable. And depending upon your economics, those can drop, just in the 19s alone, can drop to more of a half mult to a mult type range. Vis-a-vis the other ones that are more healthily in the threes, the threes, mid threes, the upper threes. So I'd suggest that on the government side, in light of the cash intensiveness of the asset and the fact that it's scheduled, so there's this cash component on it. And if there's a macro viewpoint that the economy may turn in a certain direction or a certain softness might be detected, your FHA loans are going to show that before the conventional. So I think it's more of an eyes wide open. Once you have it understood and you can model it out, it becomes a highly investable asset, and we're seeing that demand out there.
Okay, great, thanks, Steve. Brandon, Mr. Cooper has been very successful in accumulating a huge Ginnie Mae MSR portfolio. So, help out the audience here. What are some of the key factors to help issuers get the most bidders or maximize their proceeds? How do you see that?
Yeah, so it depends on the life cycle of the issuer. If you're a new issuer, it's highly recommended that you tell your story. You need to tell what your origination platform is and what it's not. You need to be able to articulate that. You need to be able to work with an MSR broker such as Phoenix Capital IMA, MIAC, people like that are out there that can help you tell your story to the market. The data tapes can only tell so much. You need to really put that element of who you are and what you are. So I think that's really key. And as you start developing that story, the data becomes obviously very important as well. Having clean data sources, being able to work with your various MSR brokers or work with the actual bidders themselves and provide them clean data, because you got to recognize they're putting typically loan level pricing on a lot of these pools, and data is obviously is paramount to do that. And then it's also, timing is a component of it too. You have to know some of the seasonality of the MSR sales within the non-bank universe. Obviously, non-banks, it's illustrated throughout this conference, are 80% of the environment roughly in Ginnie Mae land. Capital is not robust within a lot of the non-bank issuers that are out there. And so they're constantly working within their capital constraints as their budget cycles begin, as production volumes ramp up. They all need to have access to that capital. And a lot of them do that via MSR sales, right? So within the MSR function, it tends to get very seasonal during some periods, and you have to recognize that as well. The good thing is last year, 2018, was a very robust market for MSR sales. MSRs were healthy as interest rates were rising. Didn't create a lot of potential impairment on your balance sheet where you have it marked at one level and then ultimately you sell it, and potentially you're selling it at a level that you're not marked at, right? Level 3 asset, as Steve was saying. So, seasonality is very important as well. And then in terms of the construct of the pool, I think that's also highly important. You shouldn't just arbitrarily set the pools you want to sell to the marketplace. Each buyer has a different view of value on a set of pools, specifically on how they're going to price those. Are they recapturable? Do they have a recapture element embedded to them? Does that buyer or bidder, do they have a recapture capability? Or are they just going to service the loan? That's going to be a big element. Credit, obviously within the Ginnie Mae space, as we've all talked about, credit is a massive component of this process of servicing a Ginnie Mae loan. Being able to advance those P&I advances is critical. What is the servicing buyer's acts for going deep in credit, right? So you need to understand what that component is. And it really gets down to, you're going to custom create a tape for what the buyers want. And you may ultimately have 3 or 4 or 5 different tapes out there to help get to your capital requirements upon the monetization. So it's a multitude of things, Roy. It's getting your story out there. It's being able to manage the data appropriately beyond the story, and it's working through your capital requirements throughout the year as a non-bank. And then 2, it's also being able to custom create some of the tapes out there for your audience, all out your buyers.
Great insight, Brandon. So kind of to follow up on that, can you tell us a little bit about the pros and cons of, say, selling on a bulk basis versus selling on a flow basis?
Yeah, great question. So, there are obviously some benefits and there's some negatives to both, quite frankly. So a bulk transaction obviously is gonna ultimately get you a little bit better pricing. It just will. On a co-issue structure or a flow structure, you're dealing with a grid-based concept, right? And you're typically dealing with an inefficient pricing mechanism. And as we all, on the buy side, and quite frankly, the investor universe, we're all afraid of adverse selection. We're all afraid of being taken advantage of within a grid-based environment because it's not efficient. It's a weighted average approach, for lack of a better term, of how to price, a loan level or a pool level type of structure. So you're typically going to get a lot better execution. I say a lot better. You're going to get better execution on a bulk transaction because it's a finite thing. It's a known commodity. When you get a bid tape with anywhere from a billion to $20 billion worth of loans, it's finite. You know exactly at a loan level what those elements are. When you're going through a flow concept, you're essentially supporting an origination kind of framework of, hey, give me your last 6 months of production. Let me kind of review that, and I'm going to put STIPs on your average loan balances that you can deliver to us. The geographies, I may STIP some of the geographies that come to us. DTIs, FICO, et cetera. So we're going to STIP basically what you can deliver, and then you're going to deliver into a grid platform, which is a good thing because it's a known entity, it's a known item. You can price to that. You have expectations on what type of execution you're going to get. Whereas on a bulk transaction, you may not know until the bids come back, right? So ultimately, though, what I believe is works out best in this environment is really a multitude of both. Again, you've got non-banks that need access to capital, being able to monetize that asset to create capital. A lot of the MSR buyers in the marketplace, they want both. They would like to start a relationship with a bulk transaction, a finite type of structure, see how that goes with the ultimate seller, with the issuer, and then from there, work with a flow arrangement as well. That helps both parties, and quite frankly, once you marry those two together, you'll see you can lift your execution across the board on both sides because you're providing that ultimate collateral that the buyer wants via the bulk, and then you give them a known source of assets over a time period via the flow arrangement. So they both work exceptionally well. I think they both work exceptionally well within your capital framework that you have to operate. And quite frankly, it allows you to have optionality from an issuer perspective on when you're monetizing that asset. So I would recommend deploying both strategies.
Great, thanks, Brandon. When we shift gears a little bit here, Mr. Cooper has accumulated a pretty significant 75 billion, almost 80 billion, maybe it is already, Ginnie Mae portfolio. I can't keep track, but how important is financing to managing that as well as helping you buy portfolios?
Yeah, absolutely. So that's obviously been a common theme throughout this conference and throughout a lot of the panels here is the financing. Most non-banks or non-depositories, we can't just go to our treasury departments and say, hey, let's raise deposits, right? We just don't have that capability. So as always, capital is king in that endeavor. As you are looking to aggregate and grow, if you don't have a finite source of capital or a liquidity component like my friend next to me here, where they're backed by a large pension fund, a non-bank typically has to leverage financing arrangements out there to support their business. As we all know, most of our origination platforms, they're cash hungry. I would argue a lot of them are cash negative. You're burning cash to operate your platform. So you have to augment that. In terms of the financing vehicles that are out there, there's a lot. If you're going to service that asset, it's paramount that you have your capital plan formulated in order to support it. Obviously, Ginnie Mae over the last few years has grown extremely wary of the non-bank growth and the potential risk that non-bank universe provides in the event of a stressed environment. You have to have a plan in order to manage that as you grow that asset and manage it. The P&I advance, I can't stress that enough. You have to understand with your capital plan how you would support your P&I advances. Early buyout facilities, they're really a financing vehicle to help you minimize that P&I advance ultimately through the foreclosure process, right? You want to buy that loan out, and Ginnie Mae allows you to buy that loan out once a loan goes delinquent after 90 days. You can buy that out of a pool. It takes capital. Financing arrangements via early buyout vehicles will help you do that. Essentially, a way to think about that, you do get reimbursed from your friends at FHA for the ultimate P&I advance, the coupon advance you're doing, but they only really reimburse you at the 10-year treasury rate for all intents. So there's debenture leak that occurs as a result of that. Those early buyout facilities help you mitigate that and are effectively that financing vehicle. And then in terms of additional P&I advances or just ultimately being able to aggregate, there's some unique structures that some of the other panels spoke very eloquently about. The financing world of the MSR has grown since 2012. Obviously, as we got out of the crisis liquidity and a zero interest rate environment seeking yield, you started seeing those financing vehicles pop up. Obviously, they've gotten a lot better, I would argue, over the last 3 years than they were the previous 5. So if you take yourself back to 2013, when you started seeing some of these term facilities pop up to help issuers and servicers finance that asset, they were somewhat draconian. They're extremely covenant laden. The financing rate on a lot of those vehicles was pretty extreme. You're talking LIBOR plus potentially 6-7 points. And that, when you start thinking about the yield that you were earning on that asset with the financing that you're having to pay for the asset, it was like, what are we really doing here? I'm working for the fee income. I'm not compensating myself for the additional risk that I'm taking. But obviously liquidity has ensued, and we're starting to see better financing vehicles that occur out there. Like I said, some of the other panels did a great job of talking about that. There's some unique structures. Credit Suisse has been obviously involved in a lot of some of those unique structures where you've got revolving facilities now, and you've got advance rates more in the 50 to 60% range. And with that, your overall financing costs are more in the LIBOR plus 250 to 350 type of range. So in this environment, if you're earning 10 to 12% yield on that asset, and your financing costs are roughly call it 5, 6, 7%, you're actually able to earn a little bit of that carry over the top of the financing needs. So the liquidity function, the financing function, absolutely has to be a part of it. Our friends at Ginnie Mae are going to make sure that we have very cognizant of our capital needs.
And we've worked hard to help support that.
That's exactly right. That's
Government,
exactly right.
people say the government doesn't innovate, but like you said, we did introduce the first MSR financing facility, securitization. So we try and work to support that.
Right.
So Jim, can you step in a little change of pace here? You have a lot of experience working with hedge funds, retirement funds, international financiers. How do they look at the MSR investment?
Well, we actually been owned by 3 different types of capital partners over the years. Our initial capital was a hedge fund, then a private equity fund, and now as I mentioned, a pension plan. They all look at it very differently. Clearly, a pension plan of those 3 is the best holder of this asset. It's really any holder that has a longer duration and a lower cost of capital is going to be your best fit. So from an international standpoint, absolutely REITs are a good potential counterparty. Pension plans, sovereign wealth funds, equity funds, all would make sense as different potential partners. And really it's just, again, based on their cost of capital, just to match the asset versus the hedge funds and private equity funds have much higher cost of capital, and just the duration in terms of how they want to hold the trade. I think you're not really looking for a participant who looks at this as a short-term trade and wants to flip out of it in the next 24 months, but rather someone who's looking to hold this for the duration of the asset.
Great. Jim, your firm is known for having strong analytics and spending a lot of time with due diligence. Can you explain kind of what your process is in looking portfolios and due diligence?
Sure. So when we first got involved in acquiring MSRs, we kind of took the approach to build an internal both prepayment and credit models, kind of along the lines of our DNA in how we've acquired whole loans. And we did it when it came to Ginnie Mae. We decided that we really needed to do that at the loan level. And our thinking was that the Ginnie Mae asset, just based on this profile, with the higher delinquencies, really required a loan level fit versus a kind of a pool level fit. So that was our approach. As we think about taking that, we calibrate those models kind of with historical, publicly available MBA data on performance. Then we integrate that into our cash flow engine. Right? So that's kind of how we went about putting together, the models. In this case, was Polypath as the engine. As we look at a specific pool, our research department would look at that pool and compare and run the analytics on that relative to the publicly available MBA data, and create a comparison of those characteristics of the pool relative to the cohort data. Right? So it's similar cohort of a much larger universe. How does this compare? And so we think about what our investors like, what we like as we look at a pool, is comparing, and we're obviously going to pay up for pools that outperform the cohort, or pay at a fair price for loans that do perform the cohort, and be a little harder ones that underperform. So when I speak about that, I'm speaking about obviously geographic distributions, FICOs, LTVs, prepayment speeds. Those all factor in. I would say as we look at, to Brandon's point, as we look at acquiring a pool, we're going to look at the counterparty. What's the reputation of the counterparty? What's the financial strength of the counterparty? What's the prepayment history of that counterparty? What's the servicing like? Is the servicing in-house? Is it one of the generics? What's the quality of the servicing? We place a lot of value on servicing. It's very important to us on this asset, and we found it to be very meaningful in terms
not a lot of
performance.
people,
So it's been a big focus for us.
No, that's great. We could go on and on, but we're running a little short, so I want to kind of open it up to the whole panel here. Anybody jump in? Just want to ask you, we have some unique organizations here. What is being both a servicer and a sub-servicer? How does that affect the economics of servicing for both of you all, as well as, how does it affect your outlook towards acquiring portfolio?
Do you want to go first?
Yeah.
I mean, we are both a acquirer of MSRs and we subservice for others at Rushmore, and we actually, some of the pools that we subservice have been Ginnie Mae pools that have had probably credit characteristics that generate a little bit higher delinquencies. I would say that what we've heard from our clients and what we've experienced directly in our own acquisitions is that the servicing makes a huge difference. In terms of specific adherence and staying highly focused to servicing to the guidelines can dramatically limit curtailments and claim failures. In that sense, I would say your servicing is probably one of the underappreciated levers that you can pull in terms of performance on the portfolio. When we built our portfolio, we started acquiring portfolio. Before we did that, we actually went out and opened a platform in Oklahoma City. We specifically chose it because of the location of the FHA National Servicing Center, and because of the certain amount of talent specific to servicing delinquent FHA product that was available in that market, and we found that it's really paid off. So it directly feeds into our main Dallas hub and has provided a substantial lift.
Great. Yeah, I would absolutely piggyback off of that. Mr. Cooper, or formerly known as NationStar, we've got roughly over $600 billion under management at this point within our servicing platform. Third largest servicer out there, largest non-bank servicer. So it's top of mind for us. And as we look at what is our ability to both service our own owned portfolio, we also subservice. We have some very large clients that we subservice for. Really, the customer experience function, we do not delineate between the customer experience between both. A lot of the other platforms out there, they'll delineate that experience profile if they happen to be both a servicer and a subservicer. We choose not to because we absolutely do believe, I do agree with Jim, that the customer experience is critical in managing of that asset. And then in addition to that, depending on how the subservicing arrangement and the servicing arrangement are, the recapture capability, I can't underscore that enough, especially with the Ginnie Mae asset. As we've all seen, it's very subject to high CPR during really volatile low interest rate environments. The ability to recapture that asset and provide that ultimately back to with whatever arrangement you have with who you're servicing, the issuer, or whoever you're servicing that loan for, being able to have that recapture capability as a subservicing unit is paramount in terms of the total economics of that transaction. The industry right now, I believe Strathmore came out, I think it was Black Knight that came out with this, that indicated that 18% of customers want to go back to their respective servicer. Only 18%. So you're losing 82% of the time, right? So that's obviously near and dear to our hearts, and we ascribe to be 2-3 times better than that from our recapture capability. And it's really driven by that customer experience. There is no real secret sauce other than, are you providing the information to the customer, and are you providing that experience that makes someone say, you know what, I want to go back to that servicer.
Great, thank you. Next up, we want to ask the question most of the panels ask, but let's get it from y'all's perspective. What improvements can Ginnie Mae make to our program to help improve MSR, both liquidity and values? And anybody can take this. It'd be great to get all your.
I'll start from the front end, and then
Okay.
the gentleman certainly can speak
Great.
from the capital perspective. It's been talked throughout today, Roy, but in terms of rendering the the bids in a manner that would be truly translatable to be more encouraging. You know, we talked about for example, everybody talks about the splitting of pools and what would that do. You know, we've run some analyses, some sort of beta case scenarios on what we think would happen there, and to us that would certainly be a benefit. It would certainly be an improvement, I think, to the question, and perhaps not so much as far as the translatable value, the translatable price of a portfolio, but more so buoyed by, I think, greater interest in buy-side demand, where, to Brandon's point, is that you can almost tailor a customized pool now on the Ginnie Mae front. That's something we've done for years on the Fannie Freddie side, just down the road. Have yet to be able to do that to that surgical level of precision in the Ginnie Mae front. I think that'd be really cool. If we did that, I think we'd see a lot more packages come up with certain geographies, but also certain vintages, certain performances as well. I think that would translate to more demand.
Performing, non-performing. Yeah.
Performing, non-performing, and even throughout the spectrum. You know, there are some who you know, with remediation and workout policies who may in fact target, you know, those who are maybe 60 plus. That'd be very cool to see. Second point would just be in terms of we talked about the pool transfer fee as well, I think, on some. You know, if we do loan level servicing, is the pool transfer fee affected by that? You know, it's $250 a pool. It can add up. You know, we've done some trades with some members in the audience here where that's not.
We have to work on that.
Immeasurable, but that would.
We could fix that.
That would, you know, or just, you know, or a way to sort of attack that. I think both would beget greater interest and greater liquidity.
Okay, great. What else do we have?
Yeah, I mean, I think there's been a lot of great comments. Obviously, Ginnie Mae is very well aware of some of the, you know, the 2020 plan of what they're trying to do to improve the liquidity. From my perspective, you know, I agree with everything that's been cited thus far. But I would also stay and put an emphasis on the acknowledgement agreement. So today, for you to effectively encumber your asset, use it as collateral, you have to get an acknowledgement agreement from Ginnie Mae. And that acknowledgement agreement is singular. One issuer can only have one acknowledgement agreement. If you want to be able to go about having multiple financing arrangements, you really need the ability to have multiple acknowledgement agreements or multiple encumbrances against a set of assets, right? You'd still need to cordon those assets off, make that as the collateral to the ultimate financier for you. But having the ability to have multiple acknowledgement agreements, I think, would go a long way to help give issuers options as it relates to their financing vehicles.
Great, Brandon. I hope none of our OGC people just had a heart attack, but that's a good, good tip.
I'd probably just add on to that, on the acknowledgement agreements, that including servicing advances, I think is a good way to improve liquidity, and it may be in the future worthwhile to think about, you know, going down the same path that GSEs did in terms of having separate acknowledgement agreements for servicer advances, just to improve liquidity.
Great. Well, you know, I think you guys kind of set me up on that. So if everybody looks at our 2020 progress report, Michael Drain spent a lot of time just putting out, we have samples at our booth out there. You know, some of the integral things within that are trying to develop the ability to do servicing advances. We have an investor issuer concept, separating out the investor from the servicer to bring more bidders into the MSR space. And we're all working, you know, on broadening the acknowledgement agreement. And then another big piece of that, which will be a heavy lift, is kind of the loan level servicing, which obviously would help values and you know, be able to customize things a lot. So, you know, we're working on it. We're doing the best we can. Real quick, we have for one more question. So in the future, you guys, do you see anything coming down the pike that could be kind of a game changer or really disrupt the market or demand for MSRs?
The other thing I might, you know, say is there's been a lot of discussion today around what the capital reserve should be for the non-depositories, and I guess the question is, where will Ginnie Mae ultimately shake out on that, or does HUD shake out on that, and what kind of effect does that have on the support for MSRs? I think that's going to be
I agree.
one of the open questions.
Yeah, I would 100% agree with that. And then I believe one of the earlier panels talked about this, is the enforcement of being non-compliant with how you service loans. Today, you know, you go through the process and you miss one step, you may not get that claim reimbursement. That's detrimental to the overall progress of the Ginnie Mae servicing environment. I think those, and I know Brian Montgomery is passionate about that as well, but that would be a game changer. You would absolutely bring more liquidity into the space. It would overall provide more competitive pricing, allow servicers to operate without those big overhangs of, oh my gosh, I'm about to lose 20, 30% of the UPB of this loan because I couldn't get my claim back. So I think that's big.
Great.
Fully concur, and I started with rates, so I'll end with rates. I think in terms of, we'll see what happens next week with the Fed meeting, but we've gone from expecting at one point multiple rate increases this year to now expecting perhaps multiple decreases between now and Q1 2020. I think that the composition, how the Ginnie Mae buy-side composition evolves in that rate competition scenario is going to be interesting. We talk about trying to get banks back in, trying to get some other investors in this maybe new normal of interest rates, where we're going to sawtooth, it feels like sideways here for some time, with perhaps potentially downward tugs. What does that do to the composition of how people buy? And it'll be fascinating to watch.
Mm-hmm. Mm-hmm. All right, great. I'd like to wrap it up here. We're actually on time, so we won't hold you back from happy hour. I'd like to thank my panelists here. They're great. Let's hear it for them.
Thank you.
And particularly thanks Steve as a return panelist. Appreciate that. And then I'd like to thank you all for hanging in there, and hopefully this was helpful to you.